do. So, um, as previously communicated with a lot of you as business owners, executive team leaders, or probably investment committee members, a lot of what we have previously communicated with participants, be it either on the email or phone calls or the group presentations, has really focused on educating participants on what a market correction or a bear market is, as well as putting the recent market correction into context as it relates to its repetitious nature. What slide are we on right now? Can you go to my next slide? I'm just going to start this with a kind of how we've been communicating to your participants. So this is one that we use. These are data points as well as a chart we use to kind of communicate to your participants just about how bear markets are come along with the territory. They're going to happen every 6.5 years, and they're going to have different durations and different drops in the overall account value or the market capitalization of whatever index we're tracking, be it the S&P 500, etc. But just really trying to make sure participants understand this is par for the course, and if they're young, it's going to happen a lot more. Even if they're near retirement, it's probably going to happen to them 3 or 4 times in retirement as well, and then just what they can expect from them as well. We've also I'm going to stay focused on the participants, and then I'll move over to the market as a whole. But I think it's important for you to understand the voice we're talking to people in. Overall, we've just had a lot of communications about maybe it's time to reevaluate risk tolerance with participants, meaning it turns out a lot of people aren't as aggressive as an investor as they thought they were once they actually experienced the 20–30% loss in their account value. And that's where we start making mistakes, doing things such as moving all of our equity positions into a cash position or searching around for other returns. So we've been having a lot of conversations about, well, maybe now we actually know the type of investor we are. Maybe we're not a hyper aggressive investor. Maybe we're a moderate investor. Maybe we're a moderately aggressive or moderately conservative investor. So we've been talking a lot about that, just going back through a risk tolerance to figure out where you should be in terms of asset allocation. And then where that brings us is actually the next slide, which is kind of just re-educating people again on the benefits of a balanced portfolio. So versus being in a 100% equities portfolio, maybe you're the type of investor who should be in a balanced portfolio. So that would be something, for example, half equity mutual funds, half stock mutual funds. So trying to bring your risk down by about 50%. The main message, we're having to convey this really quickly over email or a phone call is if there's a correction, hopefully in one case, if you would have lost 20%, maybe if you're in a balanced 50-50 fund, you would have only lost 10%. How we've been communicating this in the larger meetings via WebEx, or if there's a opportunity to communicate via email, is actually showing this in relation to 2008. So if somebody would have been in a balanced portfolio, and let's call that a 60-40, 60% stock funds, 40% fixed income funds, after the 08 bottom of March of 09, they would have recovered to their former account balance within 12 months, right? So if they had $100,000, they lost a bunch of that. Within 12 months, they would be right back where they were and hopefully growing again. A lot of investors don't remember it that way, right? Because a lot of us were in equity funds, maybe international equity funds, small caps, took on some more risk than that. And for a lot of us, we didn't recover from that 08 correction well into 3, 4, 5 years later. So this example is kind of how we push that narrative of understanding the value of a balanced fund over a very long period of time. Hindsight is relative. You might have done better in all equities, but in the moment, that's kind of hard. Here's what a balanced fund can do for you. I thought that was an important place to start, Pete. But now I can talk a little bit about the markets as a whole. And yeah, there's a big example. So we all saw this, we all experienced this, and that's why we had so much participant engagement in the first part of this year. So since peaking on approximately Feb 19th, the S&P 500, I think this is what this is showing right here, lost 34% of its market capitalization. So what is that? What does that mean to any of us? All right, I'm gonna pull up some facts and figures here. That is the worst 23-day trading period in the last 30 years. That's a big drop. Now, on the other side of that, since bottoming out on March 23rd, the S&P 500 then went on over the next 43 days to gain 32.6% total return. So that's the second best 43-day trading period over the last 30 years. So we had the worst 30-year loss, and then the second best 42-day gain within a couple of months of each other. At this point, just so you know, we're a little bit past that. As of right now, the S&P 500 has gained 43.4% from that low of back on 322, 323. I like to put things in context a little bit better. So those are some big drops and some big increases, right? 32, 33% down, and then back up 43%. Where does that put us overall, big picture? And what we're trying to do today, one thing, this is not how we talk to your participants. We don't use a lot of facts and figures like this, but because we have a lot of sponsors, business owners on the phone today, we thought it would be a good time to just say, what's happened so far this year? So what does that mean? Year to date, that's going to put the S&P 500 essentially flat. I'm not really using today's figures, but we're down approximately 20 basis points, so negative 0.20%. That's the S&P 500. Now, the average investor isn't invested in the all U.S. large cap stock market, right? Most of them are hopefully in one of those balanced funds we talked about before, or more than likely they're in some kind of target age fund. So where would the average investor be? If you're in one of those balanced portfolios, hopefully half stocks, half bonds, right? You wouldn't have lost as much, and you would have gotten the yield from your bond portfolio. So most balanced funds are probably up about 1% for the year. The Morningstar Target Date Risk Index is flat for the year. The category, which I would categorize as 60 to 70% stock funds, is actually up at 1.5%. And I can give some examples as well. So Vanguard Growth and Income is down negative 0.21. So that's almost the same as the exact stock market, which is weird because it's a balanced fund. But that's specifically because they're taking a lot more international funds and small caps, and it's diversified. And then another example, which is probably a better barometer for participants, would be, I'm going to use Vanguard Target Retirement 2025. That's VTTVX. Again, that's a 60-40 portfolio. That's where we're seeing a lot of participants would be. And that's down 30 basis points for the year, which is right in line with their category. So participants are probably flat, right? If they have a balanced fund, if they're in domestic equities, they're also probably pretty close to flat or down just a little. So overall, we're right back where we started. What this means is, from a standpoint of communication or planning for retirement, which is really what these assets are about, it hasn't changed anyone's calculations. We're still looking back over the last 25 years of an annual return on US equities of about 10%. As many of you know, that's what we communicate in our education meetings. And balanced funds are still around that 7 to 8% annualized rate of return. So as far as retirement planning and trying to get the assets people need for retirement, a lot's happened, but at this point, we're back where we started and nothing's changed. So that's big picture. A huge down, a huge back up, more so because obviously it takes more up than down to get back where you were. What's happening in the U.S. stock markets? There's a lot happening over the last week. I'm not really going to get into that. Obviously, all of the indexes were up a lot. We had the Dow Jones up approximately 7%. S&P was up about 5%. Smaller cap indexes did even better, and value actually started outperforming. This was a global recovery as well over the last couple of weeks. So the global indexes did very well as well. Okay, so by trade, obviously, when we're doing these presentations for participants, we usually have a specialist on the phone. I'm not going to say I'm a equity analyst or economic analyst by any means, but I'm just trying to help out today. So I'm not going to really get into the economic side of it, but I think what people want to know is what's happening and why is it happening. That's hard to tell. Big picture, we don't really know where, from an analyst point of view, the capital asset pricing model, we're at a point where stocks shouldn't be really doing well, and the economic data is still suggesting stocks shouldn't be going up. But it really comes down to market sentiment has changed, and markets are usually leading indicators. So that means sentiment has changed. People are believing in stocks and buying stocks right now. But conversely, if you look at it like some people do, a lot of companies aren't providing guidance on if their stocks should be doing well or not going forward. So we're in a really interesting spot, and that's what we're communicating to sponsors. That's what we're communicating to participants. The future is a little unclear, but here are the major tactics you should be understanding going forward. I think that's all I'm going to cover today, Pete. That's a whole lot of stuff in 10 minutes, but I think that gives you a good idea of what we think's going on and how we're helping participants.
Right. No, I think that was fantastic. And I think just kind of the reminder out there is that if we do have participants that are at your organizations which are, feeling uneasy or have anxiety or just concerned about the market, it's best to have them just ping us or let us know, and we can reach out to them. If they want to be more confidential, then we can do just an education meeting for the entire organization, because we really, our goal is to obviously provide them advice, but also to educate them to a point where they can feel confident and comfortable in their investments so that they can have, a successful retirement savings program. So thank you, Brandon. Appreciate that.